Okay, this will be on accounting. And basically, accounting is the language of business. And so basically, for basic accounting, we have to know what assets are, liabilities, and business transactions, and be able to identify these. Now, you also have to know owner's equity as well. So I'm going to define these terms first so that we get that out of the way. So we have assets. Now, what are assets? Our assets are basically the resources owned by a business. So the resources that they own, it could be cash, building, equipment. And then there are rights or claims to these assets. There are number one, the right to creditor. And number two, right to the owner. Right to owner. And then this right to creditor, it represents debt, how much debt they're in, and it's called liabilities. That's basically what liability is. And then the right of the owner is called owner's equity. And here's the equation for we have liabilities, and then we get owner's equity. Owner's equity. So now what we're gonna do is we have to state the accounting equation in order to find one assets or liabilities or owner's equity. So assets basically are equal to liability plus owner's equity, which I'll just O E owner's equity. So otherwise you might get maybe assets. In order to get the owner's equity, you might say assets minus liability equals owner's equity. So from there, basically, we can provide an example of this accounting. So I will clear the screen and our example. Okay, here we go. So if assets are $100,000, that's a lot of money. Liabilities are 30,000. That's a little high of a debt, but what is the owner's equity? Okay, so we're trying to find the owner's equity. So what we said before, well, we have assets and liabilities here. So assets is 1,000, liabilities is 30,000. We want to find owner's equity. So that means that we do assets minus liabilities equals owner's equity equals owner's equity. So that means we take 100,000, $100,000 minus we had 30,000. So what does this equal? Well, 70,000. So owner's equity is $70,000. Okay. So now we will go to business transactions, and basically a business transaction is this economic condition that directly changes the financial condition. This is like when you pay company paying maybe a monthly telephone bill. It changes. So all business transactions can be stated in terms of the changes in the elements of the accounting equation. So we just change the accounting equation, and we will use the transactions with the accounting equation is what it means. So if we have like if we have a deposition of $25,000 and increased asset, so owner's equity owner's equity is also increased because of both sides. We will increase by 25,000 because we have to match both sides. So if the cash equals Chris Clark, let's say Chris Clark made this, Chris Clark capital. That's what it will say on the sheet. And what we're gonna have over here is we're going to have 25,000, and then we're going to have over here 25,000 investment by Chris Clark capital. Okay, so we're gonna do here. They exchanged well, $25,000 would be just the investment, and that's what we were just establishing here with the business transaction. And let's say he exchanged cash for land, $20,000 worth of land. So we would have a balance over here. We have 25,000 because of our original investment. I'm just going to cut off from the top, and then we will subtract 20,000 because it says he exchanged cash for land in that amount, and then we get a balance of 5,000, and then over here on the other side we're going to get the increase of assets. So because he acquired more land, so 20,000 worth of land he got. So that's basically all there is to business transactions. And if you have any questions, just ask.